Hey everybody, this is Coach D with TackleTrading.com. Earlier today, I was watching our halftime report where Matt and Tim were talking about Microsoft with their earnings announcement coming out tonight, and we talked about the potential for a volatility play. And it's not the world's greatest looking volatility play, but I thought, just for fun, we would take the simulated trading account, which is always a great place to practice, and just come in and practice a volatility play. They're about to announce earnings. The market closes in about 30 minutes. And usually this is a good strategy to try to place, 1 to 2 days before earnings. The general idea is relatively simple. Because earnings is coming out, the estimation of implied volatility is high. It's higher than normal. So here you can look back at previous earnings announcements, and this little blue line tracks the average implied volatility of the options, and you can notice that after an earnings announcement, the volatility drops. And again, it'll rise up into earnings, and then right after earnings, the implied volatility drops. The stock might move dramatically, it might not. Here we have a gap, here we have a dramatic move. Here's the earnings announcement, boom, higher implied volatility, it drops. And stock price moves a little bit. So here we are, right now, right 30 minutes before earnings, and implied volatility is just over 50%. And the estimate here is that the implied volatility will drop. And what I'm going to do is I'm going to place a short strangle trade on this. And I'm going to go out and analyze this trade first. And so I'm going to go add a simulated trade real quick. And I like to do these longer term, usually go out towards 3 months or so. So I'll choose October options. And I'm going to go out and sell some implied volatility here, some inflated premiums. And typically what I do is I look for deltas, somewhere always less than 25. So I'm probably somewhere between 20 and 15 here on the delta. And I'm basically saying, yeah, I'll buy Microsoft at 95. I'm going to sell that option and get paid to do so. Now, they are pricing in approximately $9.38 between now and October. And it's trading at 104. And so that would put you about, 95 would be just about 10 points ish. So 983, that puts you right in that ballpark. So if I wanted to be more conservative, I'd do the 92.50. Say, yeah, I'll buy it at 92.50. And I'm going to basically do the same thing on the top side. So I'm basically going to right click here. I'm going to go analyze, sell, trade. I'm going to go up and hit strangle. And that's going to create a short strangle. Now I have to go choose the upper strike price. I've got the 95 selected here, 92.50 selected for the put, and I have to select the call. So I'm just going to go out and find an appropriate call, and I think the 115 does the trick. It's got a delta of about 0.19, so I'll go ahead and sell that one. So I'm just going to change that to the 115 call. And here we go with the 115 strike. And the idea here is you're going to get a maximum credit of 224. And I'm going to, I don't normally do large position sizes with short strangles. I do relatively small position sizes on average. But we'll go look at the risk profile here. And the general idea is that, hey, I don't think that between now and October that this stock is going to move that much. That light gray area kind of represents the statistical probabilities, or what you saw in that probability cone when I was looking at the chart earlier. And I'm just going to go set these price slices here to break even. Then I'm going to go set those slices to the chart. And the general idea here is simple. I bet that Apple's going to go through earnings, and it's not going to go out above 115, and it's not going to go down below 92.50. And as long as it stays in the middle, I will potentially make money on the drop in implied volatility. Now, Apple could have a surprise, and that might mean I have to do something to control the risk or hedge the bet. But for now, I think I'll maybe do 2 to 3 contracts max. I'm going to go ahead and hit confirm and send. And the idea here is the most I can make is $672. They're going to hold $3,126 in margin. And I'm really only shooting for somewhere between, I'd say 2% to 10% ROI over the next couple of days. As the implied volatility drops out, the stock may gap up, it may gap down, it might fill the gap, it might run. I really don't know that outcome, but I know that the odds are that the market's really not expecting it to move that much. Now, before I send that in, I want to show you one last thing. I'm going to go to the trade tab here, and I'm going to show you the market maker is expecting this to move about. This is called the MMM, stands for market maker move. And I think it's not going to move more than 343 or so, and that I have given myself plenty of room on that trade. So I'm going to go ahead and bring that up, and I will go ahead and send that in and see if we can get filled here before the market closes, excuse me. And that may take a moment to get filled because we're splitting some spreads and asking for a few contracts there. And we'll just see if that gets filled here before the market closes. And that may take a moment, and I won't make you stick on that. There we go. We got it filled. So we are now short the Strangle on Microsoft. And if you look at that now on Microsoft, what we have is we have a position that has a pretty neutral delta, pretty nominal gamma. It's got positive theta, time is our friend, and it's got a big negative 80 vega for implied volatility. And that means for every 1% drop in implied volatility, we stand to make about 80 bucks. And I'm hoping that we get I'd say a 5% drop in implied volatility. We might be able to make some money, and then the stock price will move up or down. And we're hoping to win on that drop in volatility. This is called a volatility crush or a Vega crush trade. And this is Coach D with TackleTrading.com. Come over, join us, and we'd love to have you in our clubhouse.